Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're welcoming to the podcast Tyler Wilkens, Director and Head Portfolio Strategist at Catalyst Capital Advisors. He's responsible for both portfolio construction and investment strategy at Catalyst. Tyler, welcome to Compound Insights. It's a pleasure to have you on the podcast today.
Thank you, Gary. I appreciate the opportunity.
Tyler, before we dig into dig much deeper into market drivers, can you just share your thoughts? We've been in a very obviously dynamic investment environment. Trend has been upwards, but we've had geopolitical tensions in the background. How does that factor into your sort of thinking? It hasn't seemed to matter on the long run, but in the short run, it's added some volatility to the market.
Oh, yeah. I mean, that's a great question. I would say, our thinking is always constrained a little bit because of the audience we're working with. And so, what we do day to day is we're helping these RIA CIOs and these financial advisors build portfolios that are going to meet long-term risk and return expectations, goals for clients. And so through that lens, when we think about the recent trends in markets, equity performance, valuations, geopolitical risk and uncertainty, at the end of the day, there's only so much of a tilt that these advisors are in a position to implement. So they're all in a position where the S&P has been on an incredible run. For the last 10 years, it's up 15+% annualized, right? And if you go back long term, of course, that number's closer to 10% if you're doing a 20-year, a 50-year look back, right? So advisors are in this position where they're thinking, hey, I'm concerned about valuations. I'm concerned about these risks, but I can't necessarily slam the brakes and change the nature of these portfolios, or I'm taking a real risk with my clients that they'll miss out on returns, and that will become a factor that derails their entire investment program. So I think people are forced to be on the bandwagon that they're on. There's a lot of upside in markets. No one knows how things will pan out. These are portfolios that are run with real constraints for end clients who have a lot of influence.
And you just referenced the retail component of the people you speak with. That's obviously become a bigger factor in the market. Can you share your thoughts on sort of what you're seeing from that area and also what the trend has been over the time you've been following that area?
Yeah, yeah, great question. So I guess I'd open up that by saying, if you look at the size of the US retail market, and this includes financial advisors. This is the wealth channel. So not necessarily an individual on Robinhood, but rather professional investors who work for individuals. I mean, the total AUM, it ranges in the estimates you see between 25 and 40 trillion dollars. And for context, add up the 300 largest pensions around the world. How much AUM do they run? It's about 25 trillion, or at least it was in 2025, right? So this is a larger asset bucket, just US advisors versus some of the largest pensions around the entire world. And what's interesting about it, really, I think, is that, these allocations that these advisors are making, they change. The nature of these allocations shifts over time. Um, so it's interesting to get a sense of, how are these advisors thinking? Because that gives you an idea of where is momentum headed in markets.
And what's your sense now about momentum? Where is it headed?
Yeah, good question. So I think it's moving on a couple of fronts, right? So when we're working with the advisors, our philosophy is, hey, fee budgets should be directed in ways that material improve the overall portfolio outcome. So this could be a niche like opportunistic fixed income. It could be a diversifying alternative. But if we're talking about the tilts in the big asset classes that these advisors are putting in place, there are a couple of things at play. I would say international investing, that's an easy one where there's been a major sea change in the last couple of years. So look at the international equity weight in the AQUI index, right? It's about a third, it's a little over a third foreign equities in that index. And if you pull up a target date fund that might be in your 401k, it's a similar weighting within the equity sleeve. Retail financial advisors, what they've done just a handful of years ago, their equity sleeves are about 15% foreign equities, 85% US. So major US bias. And it wasn't always that way. And more recently, what we've seen is a shift towards 20% international or even higher. I've seen 25. And what's driving it, I think, is Partially, there's a behavioral element where the end client is just watching the S&P on TV all day, and they're anchored to that. And even if they're in a balanced portfolio, they're wanting to outperform the S&P 500, whether that's appropriate or not. But the other piece of it is recent history, right? So you look at the ACWI ex-US, just foreign stocks writ large. Since 2010, they've returned about 5.5% annualized, whereas the S&P over that period did about 13.5% annualized. So there's been this major just winning streak for US over international. And over the period where advisors have begun to shift towards ex-US, it is reversed. So in 2025, the ACWI ex-US did about a 33% return. The S&P did 18. In 2026, year to date, that trend has continued to a degree. Foreign stocks are still ahead for the moment. So I'd say, it's a mix of factors. It's what are the clients looking at? What is going to drive too much tracking error versus the S&P, which they care deeply about, but also, what is working? You start to get a sense for, why does momentum exist? Obviously, this isn't the whole picture, but this is a part of it. There's a huge community of people who run a lot of money who are responsive to recent returns in markets.
And we're also closing out second quarter earnings. What are you communicating on that front? What's your take, and how does that get incorporated into a portfolio?
Oh, yeah. Yeah. So I think when we look at earnings, it's tricky because if we're not doing kind of a bottom-up analysis of all of these earnings calls and taking a view on many, many equity securities, then we're in a position where we need to have a little bit more of a top-down macro view. And if you look at valuations, I mean, take a look at the forward PE. Forward PE on the S&P 500 was about 23 recently. It's ticked down a tiny bit as earnings have moved. But if the long run average is 16, I think you can make an argument that, the earnings are exciting. Maybe cash flow is a little less exciting at the moment, but the earnings are certainly excellent and they're expected to continue to be that way. And maybe the market has already appreciated that to a high degree. Still, we don't want to be telling advisors to make big tilts for or against equities. What we're trying to do is take a longer run view. We're trying to use tools like, mean variance optimization, contribution to risk, factor analysis, things like that to show them how do we stay invested in some of these markets, even if they're expensive, while still seeking diversification and value elsewhere, so that if we find ourselves in a market where equities are disappointing, you have a story to tell your end clients that's positive. You did something in advance to prepare them. And, you're not necessarily going to take the same drawdown that the S&P 500 will. That's our goal.
And you just touched on the macro. We have a new Fed chairman in. His approach seems a little bit different than his predecessor. What are the implications in your mind of having a new Fed chairman such as Warsh in there?
Oh, yeah. I think looking historically over the last 2 years, you've seen the 10-year and the 30-year rate is continuing to rise over time, even while the Fed was cutting rates. The intermediate and long rates were rising. And, obviously, it's not all coming down to current Fed policy. It's inflation expectations, it's supply and demand for treasuries, things like that. And so our view is obviously there's a question mark with what will the new Fed chair do and what will the rest of the governors vote for. But longer term, I think some of the bigger trends that are in place, for example, the amount of U.S. federal government borrowing, the deficit is about 2 trillion a year now. That's up from 600 million a decade ago. So that deficit is way up. There's a lot more supply coming online. And worries about inflation. Inflation, as we all know, has been sticky. It's above target. There's a lot of concern over inflation. There are many retail investors out there worried about currency devaluation, things like that. So there's plenty of room for risk from rising rates. And so that's something where we see a lot of advisors taking action. You look at the duration on the US ag, it's about 6 years. The advisors that I'm dealing with, a lot of them are coming in substantially below that. We've got portfolios with 3 years duration, 4 years duration, commonly. And the last thing I'll say in that realm is the allocation to treasuries. So treasuries are about half the ag. If you kind of add up the three big sectors, securitized, including mortgages, obviously, corporates, and treasuries, the ag is about half treasuries. If you reverse 10 years into the past, it was about a third treasuries. So there's no rule set in stone that that's the right allocation. What advisors, again, are trying to do is get a little more diversified and not be so beholden to that one sector of the market simply because the US government has been borrowing more and it's growing as a share of the ag. So there's definitely a lot of activity with regard to the Fed, but also just fixed income sectors more broadly. A lot of thinking there.
And just on inflation, when you think about building portfolios, if inflation remains structurally above the Fed's target, how should investors think about that? How should they plan for that in their thinking, whether it's interest rates or just other factors?
Yep. Yeah. Good question. So we do a lot of work with advisors on real returns, sometimes after tax real returns. And that's where, especially in traditional fixed income, the payoff starts to look a little less enticing than maybe it would have in other environments. But if you're dealing with, inflation that's coming in, say 3.5, 3.8, something in that range, and your fixed income portfolio, if we look back long term, bonds tend to return about 4% over time, and maybe that'll be a little higher in this environment. But there's not a huge spread there, and that's before tax, unless you're operating in an IRA, which is often not the case, especially for high net worth investors. So we're very concerned about that. We're looking for additional defensive plays, sometimes beyond fixed income. Doesn't have to be shorter duration fixed income. It could be, liquid alternatives. That's frankly a space where my team spends a lot of its time simply because Catalyst Funds, the firm that we work for, their mandate and their mission is to take some of these institutional grade strategies from third-party investment managers and make them available to these retail financial advisors through vehicles that we operate. And so if I can do that math and calculate a better way for these advisors to get a little bit of defensive positioning in their portfolios that doesn't necessarily involve assets whose returns will be so close to the rate of inflation, especially after tax, that they're at risk of losing real money over time, then we can add a lot of value there.
Any other macro data points that we haven't touched on, but you're focused on, and what kind of trends do you see on those data points?
I do think that if we're looking sort of top down at big picture items, the other one that maybe is of interest is adoption of alternatives in US retail. So there was a nice really study a couple of years back. It showed institutions had an average of 23% of their assets invested in alternatives. Alternatives writ large could be private equity, private credit, liquid alts, whatever it may be. And the number for advisors was 6%, right? So 23% for institutions, 6% for advisors. And if you talk to Morgan Stanley, Merrill Lynch, these are some of the largest firms out there in the broker-dealer space. They're telling their advisors, hey, you should really be looking for a 20% alternative sleeve. And I think part of the reason why is that options have proliferated in the space. There are a lot more strategies to choose from that have good track records that go back 5, 10, 20 years in some cases. Um, Fees have come down. Also, if you access some of these strategies through liquid, say a mutual fund, for example, or an ETF, performance fees are not allowed. So you're not going to run into that to the degree that you would in an LP or a private vehicle. So I think advisor adoption of alts is ticking up. I think that it's moving beyond private equity, private credit. That obviously was a huge trend for the last couple of years, and there are firms still raising a lot of money there. Some of the illiquids, I think, have given people pause with the gates that they sometimes have to implement. And just with the way that, NAVs are calculated, it's not quite as transparent as a liquid strategy. So I do think there's a lot of opportunity there, and that's where fee budgets are gravitating, and that's where they should be gravitating because that's where you can generate alpha for a portfolio.
And Tyler, when you think about when you speak to your clients, are there aspects of investors thinking that you think sometimes they overemphasize some aspects? You mentioned a focus on the S&P 500.
Mm.
Are there other areas you think investors are too focused on and they should pay a little bit less attention to?
I'd have to say overall, by far, the number one area that they pay too much attention to is equities. They are watching the S&P 500. I've had advisors say to me, I have a client, they've been in the market for about 10, 15 years in a material way, and they've never gone through a real drawdown. We had 2022, but it was brief. It was a V-shaped recovery. I've got unfortunately end clients that I've heard about who have expectations that will deliver 15% returns in a balanced portfolio, right? They want to beat the S&P 500. And so I think, frankly, that's where a financial advisor kind of earns his keep is on educating the end client in terms of what is realistic and what should you actually plan for with your investments, just to prevent them from taking too much risk, saving too little, or I mean, the big killer obviously is there's a big drawdown in markets, and that investor decides to throw his investing plan, his investment program out the window and go to cash. That's the killer. There are always stories, if you talk to advisors, of a client who did that, particularly after 2008, who went to cash, stayed there for a decade, maybe more, and frankly just got left behind waiting for the next drawdown to get back in. So I think that's where the battle really is. Other than that, it's really, I think, in terms of portfolio construction for retail financial advisors, I think the key is not just balancing the overall outcome in terms of risk and return, but also looking at each individual line item. So I can give you an example of what I mean here. I like to think about it as statement risk. But say you have an end investor's or an advisor's portfolio, and you've calibrated it properly so that it's seeking the right risk and the right return overall. But within that portfolio, say there's an investment, it's an alternative. It's something the advisor is going to have to explain to clients. He's going to have to convince them that this is a good hold long term. It's got a zero equity correlation, a good Sharpe ratio, um, and say it's 15% vol. So it's pretty aggressive. Not quite where stocks are, but it's right up there. So if this investment has a material weight in that portfolio, say it's 5%, 10%, that's an investment that could return, negative, say 10% a year. If it does that 3 years in a row and stocks are up, suddenly the entire investment program is at risk. Suddenly, this advisor has to explain what happened there with that particular investment. And if you can't keep that client invested according to the plan that you set for them, then all of the other work you did goes out the window. Everything is a waste. So I think that's the challenge for retail financial advisor portfolio construction is that it has to make sense in aggregate, holistically, but also each line item has to be defensible. And again, I think that's where security selection is different for retail.
Tyler, shifting into investment themes, what are the key ones you're emphasizing in your own work or you're hearing from financial advisors?
Yeah, so I would say, there are probably two that top the list. One obviously is AI. It's on everybody's mind. And advisors are about two minds of this. I think on the one hand, there's a lot of excitement. There's a lot of belief that you need to be invested in these companies. You need to participate. But there's also a lot of concern that the valuations are very high and potentially the labs will be disrupted, or maybe even some of the manufacturers of components will be disrupted over time, and those margins won't stay at 75% forever. So there are definitely investors who are thinking, hey, what are the other ways to play this beyond, chips, beyond specific hyperscalers? So energy, I think, is one thing that has come up. It's interesting. Energy was about 7, 8% of the S&P a decade ago, and right now it's 3% because so much of the capital has flowed to tech and comms. So we have advisors who are putting in positions. Sometimes it's nuclear, but a lot of times, frankly, it's natural gas. I think natural gas is the easy solution for a lot of the AI demand. And also, there's the disruption in the Middle East. So there's a supply issue and a demand issue happening at the same time. I think that's huge. The other theme that some investors are thinking about is defense. This feels like, maybe American hegemony is on the decline. Maybe it's a world that's kind of bifurcating a little bit. And so there are a lot of, obviously there are thematic ETFs that are out there, but we've got clients buying individual securities as well, where they're hoping to place bets on a world where there's more of a premium paid to defense. There's more spending in that area. And there's potential for maybe newer companies, smaller, more innovative companies with more upside to play a role. And that's something that, frankly, always gets advisors interested because I think they're looking to differentiate beyond passive. They're looking to find that next generation of winners, especially if they're buying individual securities. So, a lot of interest, I think, in AI, of course, but also other things like energy and defense.
And just back on AI, what about the concentration risk in the market? How do you think about that? How do you communicate that? And how do you manage that process?
Yeah, great question. So we've all seen that stat, I think, that about 40% of the S&P is in the top 10 constituents. I think NVIDIA is about 7.5% just by itself. So on the one hand, we all want to diversify from that. It feels scary. It feels like too few baskets for our eggs. On the other hand, if you have diversified, then you've got, a group of clients asking you why they're lagging the market, which has been very, very tough. So I think again, there's this catch 22 where there's a group of advisors who've moved towards value. They've moved towards international, maybe before 2025. They moved towards small cap before this year. And in every case, if you've diversified beyond those winners, it has hurt you. So it becomes a question of, can you explain a long-term outlook to your clients? Can you keep their faith sort of invested in you? And over time, it's possible. We've seen obviously drawdowns in Meta and Apple. You've seen some bifurcation between the winners and losers among those top 10 constituents. And there's room for momentum to turn and things to change. But in terms of timing that, I think that's a very tricky thing to do. I think when we advise advisors to put tilts into their portfolio, we're always thinking about how much tracking error are we going to take? What is the size of this tilt going to be? Because it has to be sort of a constrained enough bet that you're placing that if you're wrong for a period of time, the entire investment program doesn't go out the window. That's always on everybody's minds.
Looking at artificial intelligence from a different direction, do you have a view as to how that might change the management of portfolios longer term and how to use it yourself in your own work?
Yeah, so definitely we do use AI. I tend to use it the most for research. If there are open-ended sort of information gathering activities that I'm doing, I think it's great because it gives me a very quick way to pull in a lot of information. I can read the underlying sources directly from the output the AI has given me. It feels like an easy way to get a base of facts together. Where I use it less is in the sort of core workload of optimizing portfolios and analyzing existing investments. Obviously, there's some research you can do in terms of existing investments, but a lot of our process is systematic already. So I don't want an LLM sort of doing an optimization or anything that I can achieve with a program where the outcome is always predictable. I would much rather use a systematic approach where the sort of detail matters a lot and where there's very little room for error and where it's already very efficient. So I think for us, AI is all about research, information gathering. My personal belief is for investors more broadly, as they incorporate AI, early adopters, maybe they'll generate more alpha. And then over time, perhaps markets will simply become more efficient as it becomes table stakes, as it becomes a part of the underlying architecture of markets. Obviously, there's efficiency to be gained there. There's value to be gained there. You can do a lot more with AI. I do not think that we're going to be able to hand over portfolio construction to an AI and agent and just sort of let it run. I think there's too much room for error, and there are too many factors to consider, including human factors, that just don't show up in a quantitative analysis of a portfolio.
Tyler, moving into portfolio construction, when you look at a financial advisor's portfolio or just in your own mind, thinking about constructing a portfolio, besides the potential performance or the actual performance, what factors carry the greatest weight in your evaluation process? What do you look at?
Oh yeah. So For sure, the most important factor in any portfolio construction exercise is asset allocation. But then beyond that, it's the availability of the individual investments. I mean, that varies hugely from one firm to the next. It depends which client we're dealing with. And then also the individual's appetite for alternatives in a portfolio, for tilts versus indices in traditional markets. I think in a perfect world, we might run an optimization and find that uh, a 35% allocation to alternatives technically gives you the most efficient risk-adjusted return over time. But the reality is we're going to need to constrain that to take account of, what will those end clients actually be comfortable bearing because they're going to experience the outcome every single year and evaluate whether or not they want to stick with the program. And also, at different broker dealers or RIAs, there are different investments that are available. I'm sometimes dealing with an advisor who, he may love buffer ETFs. He may love a particular option strategy. He may be seeking a lot of income, even if it's derived from options or maybe high yield bonds that are highly equity correlated, right? So we're always trying to build the best portfolio we can based on the individual circumstances that we're encountering. But our goal is always, A, maximize risk-adjusted returns consistent with the appropriate level of risk, and B, control that statement risk such that no particular element of the portfolio generates either a drawdown or just lags broader benchmarks to a degree over time that the investment program itself is in jeopardy.
And from a strategy perspective, is there sort of a model portfolio that you are suggesting these days between equities, fixed income, and alternatives?
Yeah, actually, Catalyst Funds, and my team at Catalyst Funds put together a series of investment models that we sometimes talk to clients about these. And we view this as kind of a best-in-class, third-party managed, largely third-party managed approach to building a portfolio, right? So there are about 18 investments total. Four of them are from us. And you'll remember that Catalyst Funds isn't one investment manager. We work with several third-party managers. And so each of these investments that we've incorporated from our own firm comes from a different investment manager. So if you look at what we've got, a moderate portfolio, it's about 50% equities, and that includes Vanguard, Fidelity, WisdomTree, Janus, Avantis, a series of best-in-class managers where we think we're getting um, sort of bang for our buck, for lack of a better term. We're trying to keep fees low in US large cap equities because it's been very difficult for active managers to outperform in that space. It's funny, if you look in Morningstar and you evaluate retail mutual funds, the Russell 1000 Growth has been a top decile manager over many periods. It's very difficult to beat that index. For fixed income, the same moderate model, it's coming in at about a 27% weight. And again, Catalyst shows up, but also JP Morgan, CIFC, Rational Investments, iShares is in here. And what we're doing in fixed income, of course, is some of what I talked about before. We're trying to get our duration to a place that we think makes more sense, given the possibility that rates continue to rise as they have been. We're also trying to bring in some asset classes that have been very efficient over time, like bank loans. Bank loans have had an excellent Sharpe ratio, correlation to equities of about zero point 0.6 versus zero point 0.8 for high yield bonds. So there's a lot you can do in fixed income, including some special situations, some alpha drivers. And then for alternatives, we're coming in at about 22%. And we're not incorporating the illiquids in this model. It's possible for us to do that for advisors who want it. But I think for the catalyst models, our belief is that a lot of the value from alternatives is really in diversification, and liquidity is hugely valuable for these individual investors as well. I think investors might be comfortable with lockups until they actually hit them and need the money. And if you find yourself in a situation where you can only get 5% of your money per quarter, 20% a year, it's going to take you 5 years to get out. That's a proposition that I think we're going to find doesn't work very well for a lot of end investors, and unless it's a very small slice of their portfolio. So in any case, we have things like real assets, we have non-correlated managed future strategies, we have merger arb. All of these sort of different liquid alt strategies make an appearance in these portfolios. The one thing I would say is if we are looking at liquid alts, it goes back to that example I gave earlier, where, a correlation of zero to the S&P 500 might not be ideal, especially if you have a significant amount of volatility in that alternative strategy. So the question here is, how consistent is the return, and how much tracking error do you take versus the S&P 500? Because those are the quantities that tell you how an end client will fare when they're trying to experience uh, those returns. So if you have, say, an equity correlation of zero point 0.5, you're much less likely to put in negative returns in a year when the S&P is up 15%. It could still happen, and it might happen to a degree, but a correlation of zero to equities, while it's technically efficient and it's fantastic for institutional portfolios, for retail, what I've found is that individual line items that blend equity and diversifying alternative exposures tend to be the most successful over time. They're easier to continue to hold. And if you continue to hold them, you realize the benefits that you were after in the first place when you bought them.
We spoke earlier, we touched on technology, energy. I'm just wondering from a portfolio construction perspective, are there other sectors that you're favorably predisposed towards?
Yeah, I think in fixed income, definitely, floating rate has gotten a lot of attention, whether it's investment grade bank loans or even some of these mortgage securities that are a little more obscure. For example, in Catalyst, or rather Rational Funds, partners with ESM, and they run a strategy. It's a special situations income strategy where, they're able to look for individual equity, or sorry, fixed income issues where that are misunderstood, that are mispriced in the market, simply because there may be interest payments that should be made from, say, a sponsor, a loan servicer, that are not being paid correctly. And this is capacity constrained. These are going to be isolated incidents. But if some of these special situations can get picked up by this team, which specializes in this, they've got lawyers, PhDs, they're combing through these documents, looking for these situations. What you can sometimes find is a situation where you can derive a fixed income exposure that has alpha. It doesn't have so much duration exposure, that doesn't load you up on too much credit. And so we can stay away from some of those exposures that are a little more prevalent in bond portfolios and tilt towards something that's a little more diversifying.
And what about sectors to underweight? Are there ones that fall into that category for you?
What I have seen recently that I'm a little concerned about is a handful of muni exposures, taxable portfolios, where an advisor has set up a fixed income sleeve that's very efficient from a tax perspective, but it'll include municipal bond funds that have maybe 10 years duration, sometimes 12. And it's interesting that you'll see a series of these stacked up side by side, and that'll be the majority of the bond portfolio. And so you'll end up with a portfolio that has 10, 12 years duration. And it's quite a bit more volatile on the fixed income side than you would typically see. I think this is something we're worried about, too much of a concentrated risk exposure coming from just one sector. And it's easier to notice that in taxable portfolios because people get pushed into certain investments that are tax efficient. So that's something we're on the lookout for. In equities, it just goes back to concentration. The amount of the S&P 500 that's in tech and comms, it's about 40% total. That's similar to how it looked back in the tech bubble. Is this right or wrong? It's an active bet to step away from that because the wisdom of the markets is telling us right now that that's where the value is and that's where the investment should be. But at the same time, there's a well-recognized phenomenon called momentum and also trend, which at a certain point tends to reverse. And so you can make an active decision to pare that back a little bit, but I'm wary of paring it back too much, because it's hard to go against the wisdom of markets. And if you get it wrong, you can only be wrong for so long before your clients stop tolerating that.
And how should portfolios be risk managed or stress tested in light of what you just focused on?
Yeah, good question. So, I think especially for a retail audience, we try to focus a little bit less on the abstract, sort of factor-driven stress testing, where we're trying to break down a portfolio into its component factor exposures and calculate what might happen in different hypothetical scenarios. Instead, I think what's easier and more useful for these end clients to understand is an analysis where you look back at the actual performance of their holdings. And sometimes you can supplement that with, say, a Lipper category to represent an individual holding with a short track record, or an index if the investment is pretty straightforward and simple and traditional. And so what you can do then is, calculate for an advisor, hey, how would this portfolio have performed in the tech bubble collapse? Not to say that you did this 25 years ago and this is what happened, but instead, if something similar happens in the future, there's an analogous situation, obviously, is AI. If it pans out, and stocks continue to shoot towards the moon, that'll be one thing. But if we've overbuilt the infrastructure and some of these margins collapse, competitors enter the space, and these profit expectations that we have in place currently don't pan out, then it's useful to look back at that scenario and say, what might happen to this particular portfolio? And are there any changes we can make that, don't expose us to too much tracking error that would have a material impact and improve that outcome substantially? So that's what we do quite a bit of. We'll do a lot of scenario analysis. And then also, again, at the individual security level, we'll keep an eye on individual security risks. If there's something in a portfolio that's, say it's a conservative portfolio with one high yield fund in it, is that appropriate? Even though the overall risk of the portfolio might be right where you want it, you might get questions from that advisor, or from that end client rather, about that position, and that may damage the end client's sort of trust in the overall process and in the broader portfolio. So you want to keep an eye on both things.
And what role should cash play in a portfolio today?
Yeah, our view is generally that, cash shouldn't be a large allocation. If you're being paid by an end client to invest their money, you're not necessarily adding a lot of value by leaving it in cash. And if you feel that you have a tactical process where you're coming in and out of cash opportunistically, maybe that's one thing, but I think history has shown that that's one of the most difficult things to successfully implement, and that, most people who attempt to do that don't succeed. So, no, our view is cash should be relatively limited. I think there was a period, maybe a year, 2 years ago, where cash rates were elevated. Inflation was not yet as high as it is today, and there was more of an argument there for a wait and see approach. But I don't think we're in that environment anymore. At this point, I think advisors are going to have to step out into other asset classes and take some risk with the assets they've been asked to manage. Um, because it's just not fair at the end of the day to charge the clients a fee to sit in cash. That's the view.
Any particular data points or thoughts on sort of what would give you pause on the market as far as potential pullbacks? What would you think caused it to pull back?
Oh man, I think if you look back at prior pullbacks, it's often driven by an earnings miss, something like that, an update from a major constituent in indices that kind of disrupts the narrative that everyone has been latching on to, that sort of reverses momentum. We haven't seen that yet. We've seen, obviously, Meta had a miss, Apple had a bit of a miss, but on those same days, Amazon, Microsoft did phenomenally well, and those outperformances by the winners fed right into the narrative that's been powering markets. So I think valuations are probably at a place where there's potential for losses to occur at a certain point, but what you need is a catalyst, and the catalyst will come from some material event, either earnings, or a projection from a constituent, a top constituent in the industry, maybe something geopolitical, if something very big happens. But at this point, with AI and that whole segment sort of driving so much of the outcome, it feels like that thesis is going to have to change or be disrupted in some way in order for the run to stop. Because the advisors I'm talking to are not in a position to start selling whole hog, given that this appears to still be running.
What about the degree of margin leverage in the market underpinning portfolios?
Yeah, we've seen that. We've seen that margin leverage is at a record. Levered ETFs are being launched every day. They're attracting record levels of capital. Options, a lot of options activity, even short dated options, that's at a record. So certainly, I think that's part of it. But I think at the end of the day, that behavior won't necessarily stop until the narrative changes. So unless there's some other lever that gets pulled that cuts off access to all of those things, there's no reason to expect that their existence or their elevated sort of role in advisor exposures today is going to drive a reversal of the trend by itself. The ammunition is there, but you're going to need some kind of a spark to actually cause those dynamics to reverse.
And the traditional 60/40 portfolio, does that still work in today's environment, or does that need to be rethought?
Definitely, if you talk to advisors, they're rethinking that. The easiest thing, unfortunately, that a lot of them have done is shift to a 70/30. They've gotten a little more aggressive, just given where returns have been, especially returns on bonds. So 2022, I think, really shook people up. You experienced, I think, about a 13% drawdown in the 60/40 in that year. It was very little protection from bonds. They were down right along with stocks. So I think the idea that bonds are not necessarily going to provide the level of protection that clients need, that has become ingrained, I think, across a large swath of the advisor base. I would say about 80% of my advisors are cutting their duration. Maybe 15% are ambivalent, and 5% are extending it. Every now and then you do encounter someone, advisors are idiosyncratic, you encounter someone extending it. So fixed income has been a negative. Alternatives is something that advisors have now been expanding into, sometimes as a way of, replacing that fixed income exposure. But I think the key point is for these advisors, 85% of the risk in a 60/40 comes from the stocks. So if you really want to drive a material improvement in that portfolio efficiency, what you need to do is find some alternatives that are calibrated properly for that portfolio. So we're talking volatility between 10 and 15%. I would say an equity correlation between zero point 0.3 and zero point 0.6, and a decent Sharpe ratio. If you have an investment like that, you can fund it from a mix of stocks and bonds, and then you can materially diversify. I think if you're just going after bonds, it feels good because they've done badly, but it's not enough.
Lastly, Tyler, we've covered a variety of topics from process to portfolio construction to navigating market uncertainty. In summary, what would you say is the playbook for portfolios for the next year or so? How do you think about it?
Oh man. Yeah, I saw a really good study a while back where they looked at the relationship between the 1 year equity market forecasts from all the big Wall Street firms and the actual returns that ended up occurring over that year, which had been forecast. And I think you can guess what the correlation was between those two things. It was a correlation of zero. There's no relationship. Nobody knows what's going to happen over the next year. There's no crystal ball. I would say, unfortunately, where we're at is we're stuck in the same situation that all these advisors are stuck in, where what we need to do is put a handful of tilts in that we believe in, but make sure that they're not so big that we can't afford to be wrong, at least over a year or two. And then also anywhere we can direct our fee budget to help us diversify more efficiently and go after some high Sharpe ratio alts that are properly calibrated. That's what we can do. Because for all I know, the market will continue to run for another year or two, or maybe more, or it might be down. Actually, gold I think is a good example here as well. Right at the peak of gold, just recently, I had advisors sort of banging down the door asking me, what do I do with gold? Gold has outperformed equities over the last 20 years. Long term, it's a better investment. Shouldn't I be owning more gold? And then next thing you know, it's down 25, 30%. So there's just in the short term, there's no way to know. You can plan, you can have a strategic allocation long term. You can tilt it based on your views over what's going to happen short term, but you should not put yourself in a situation where it's going to be make or break if you get that call right.
Tyler, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in financial markets. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon.